Good morning, good afternoon, everybody. Thank you very much today for joining this virtual launch of the report on Just Finance India. I'm happy to see that we have, I think today, more than 100 registrations already. And the program as it stands today will have in the opening remarks coming from Amal, and then followed by a presentation from Nick Robbins on the global context of just transition, and then followed by some highlights of the findings of this report from Suranjali Tandon. After these presentations, we will get into a panel discussion, and we have three eminent panelists with us today. Kate Hughes from the Asian Development Bank, Neha Kumar from the Climate Bonds Initiative, and William from the HSBC Asset Management. And then we'll have a Q&A session, and we would love to listen to you, your suggestions, observations, and responses. And before I request Amal to say a few welcome remarks, let me tell you about this particular project, how we began in the end of 2021. And we worked on this project over 5 interesting tracks where we engaged with more than 80 experts working in the field of climate finance. These tracks included those with the multilateral development banks, private sector financing institutions. We also had a discussion, a track focusing on the place perspective of just transition, and then on jobs and entrepreneurship, and followed by policy. And while we had these engagements through these tracks, we also had several bilateral discussions, and all this helped us in coming up with this report on the financing just transition. The subject today, of course, is very important, and therefore we believe that this report will add some value specific to actionable points in the context of India. And in many ways, given Government of India's very recent release on the long-term low-carbon development strategy, which was released very recently in 2022, we do see, and we hope to see, more and more traction in India on financing just transition. So with this introduction to the background of this report and the way we have structured today's virtual launch, I'll now request Amal to do the welcome. Amal, as you know, is the director at Climate at the British International Investment. Over to you, Amal.
Thank you, Prasad. And good morning, good afternoon, good evening, wherever you are. So I'm delighted to make a few introductory remarks to this excellent event. First of all, I think it's important to understand that how important the just transition agenda really is to any climate agenda and any climate action. And for this reason, at British International Investment, we've placed just transition as core to our approach towards aligning our finance and investment with the Paris Agreement, so core to our climate strategy. The other two pillars of our strategy are to be net zero by 2050 and to also invest more for climate adaptation and resilience. And we see the just transition agenda as central to both those pillars, actually, recognizing that as economies transition, it is essential that the potential opportunities in terms of new jobs and new opportunities for income are widely shared by local communities as well as domestic society and populations. And also, very importantly, that any potential negative impacts of that transition are also minimized, and specific attempts and efforts made to enable those communities and workers that may be negatively impacted to be part of the net zero transition in a way that benefits them. So we have actually been working to pilot, if you like, or understand what the just transition means for our investments and our investing as a private sector DFI. So in 2020, we actually developed our approach where we've been looking at how to pilot, invest in a way that supports the just transition, and enabling lessons to be learnt from that, so that we can then form a more of an in-house view as to how then we will invest more. At the same time, though, we also recognize that in certain economies, in particular, India being obviously a key one in the transition to net zero, that it will be important to understand better what the financial sector, and particularly the private financial sector, can do to help facilitate and enable the just transition. So we've engaged in some thought leadership with others, including the panel here, the London School of Economics, and colleagues from India, as well as also some work in South Africa, where we've been working with the Trade and Industrial Policy Strategy institution to understand what the just transition means there. Broadly speaking, we see that there are several key dimensions to the just transition. A key one, of course, is how to enable better skills, development of skills. And so in India in particular, when we invested in IANA, the utility scale renewable energy platform, we also brought alongside some technical assistance from our BI Plus funding to enable and support training of youth and also women to ensure that they would be able to benefit from good quality jobs within the renewables sector. We also, in 2020, launched this work that we will be talking about here today to understand what a just transition finance roadmap looks like, with particular implications for how to mobilize private investment and really enable the private sector to be a key contributor to the just transition. So the report that you'll be hearing from shortly sets out some of the key dimensions and key elements that are essential to enable a just transition, and in particular to enable the role of the private sector to contribute towards that. It is a very multifaceted issue, the just transition, and of course there is always going to be a role for governments, whether that's central governments, state governments, municipal governments as well. But of course, by engaging and working alongside the private sector, we consider, and this report confirms, that there are going to be many private sector opportunities that can be unlocked through a specific focus on the just transition. So I'm delighted now to be able to hear from my colleagues about the report and join the panel later on. Thank you, Prasad.
Thanks, Amal. Moving forward, I would like to request you, Nick, if you could talk about the just transition finance, give you kind of a global context. I think that will help a lot before we then move into the specific of the report from Suranjali. So over to you, Nick.
Well, thanks so much, Prasad, and really brilliant to work with you and Suranjali on this report. And thanks so much, Amal, for your partnership with BII on this. I'm really looking forward to actually the discussions and the presentation. So I'm going to nervously try and share my screen, and I'll just run through okay. Can you see that, Prasad? Is that okay?
Yes.
Brilliant. Okay.
Perfect. Yeah.
So what I'll try to do before Suranjali goes into the details of the report itself, is just give a little bit of a context about the overall global context for just transition finance. So clearly, just transition is rising up the agenda. It's embedded in the 2015 Paris Agreement, the importance of including the imperative of just transition of the workforce and the creation of decent work and quality jobs as part of climate action. And that phrase, really important in accordance with nationally defined development priorities. We have, alongside that, we have a set of just transition guidelines from the ILO, which came out in September of the same year, which really sets out all the various different dimensions of this, highlighting the need for transitions to be well managed, focusing again on the importance of decent work for all, but I think also adding these other dimensions of social inclusion more broadly, and this focus on the just transition being part of a tool for the eradication of poverty. I think one of the things that is very, very clear is the just transition is in a sense not a new concept, but it's actually a way of connecting the environmental and social dimensions of the SDGs. So very clearly SDG 13 on climate, with SDG 8 on decent work, but also the SDGs on gender, on ending poverty, reducing inequality, education, and so on. So really it's a connecting issue rather than perhaps a separate subject. Now, since sort of 2015, where it really entered the sort of policy and sort of business and finance world, it's really been rising up the agenda. And I think we saw that last year at COP 27, where all the governments of the world highlighted the importance of just transition and launched a new just transition program within the UNFCCC. And this highlighted the importance of social dialogue in the just transition, of social protection, and also, again, this need to really focus on the specific priorities of different countries being very different. We're also seeing a number of different ways of taking this forward, so-called Just Energy Transition Partnerships. South Africa came to the COP last year with a almost 100 billion Just Transition implementation plan, and that is supported by some international partners. And Indonesia as well has also launched its JET partnership of around 20 billion. I think also it's perhaps worth considering the just transition within the wider focus that governments took at the Sharm el-Sheikh COP on the need for financial transformation, where particularly governments highlighted the need for the transformation of the financial system to mobilize capital for net zero, particularly for developing economies and emerging economies such as India. So I think seeing just transition as part of that wider sort of financial transformation is important. And then perhaps the most important thing that came out of the Sharm el-Sheikh COP was the establishment of the Loss and Damage Fund, really meeting the demands and needs of developing countries to focus on how to deal with the actual damage that is being caused. So it's a climate justice breakthrough. And as I think as Amal highlighted, just transition is relevant both for the sort of mitigation net zero, but also for the sort of resilience and potentially the loss and damage priorities. So just some of the things, I think, highlighting how far this has moved, particularly at the sort of global policy level. In terms of finance, it's something we've been working at LSE for a number of years. And I think by talking with investors and banks and DFIs and so on, I think taking the overall just transition principles, which we have from the ILO and so on, that actually sort of three big themes come out for financial institutions, particularly for investors. The first is this question of social risks, is understanding, anticipating, assessing and addressing the social risks of the transition, for example, potentially in sort of high carbon sectors, but there may also be risks as we build out sort of green sectors like renewables, for communities that we need to be really on top of. The second is really seeing how we can seize the social opportunities, identifying and enabling the social opportunity of the transition for more jobs, more green jobs with decent work, reaching also communities that perhaps haven't been had those opportunities, particularly in terms of gender and place. And then crucial to the just transition is participation, ensuring meaningful social dialogue in the workplace with trade unions, and also participation of effective stakeholders. And the stakeholders that I think that are key to this is clearly workers, formal, informal, supply chains, communities, and also in some cases consumers as well. So just, I think, thinking about how we take this imperative of the just transition and these sort of three areas into what it means for particularly sort of the private investment community, which is the focus of this work. I think the 5 areas we've identified, and also I think these are things which came out in the work in India in particular, was for financial institutions, investors to incorporate just transition into their transition plans, which many financial institutions, banks, investors are now drawing up. The second is making just transition part of the investor stewardship with business, part of the engagement process with business. The third then is then to allocate capital specifically for activities which are consistent with the just transition assets, and I think particularly the role of bonds is going to be very important there. The fourth is policy dialogue. Clearly, as with broader climate action, clearly governments have the leading role, and governments are the sort of key player in terms of just transition policy, and also working with public financial institutions. And then finally, obviously, we really need to know whether we're making progress, so financial institutions should measure their impact and disclose. So that hopefully provides a bit of context. I think there are more sort of tools and guidance out there, and the little picture on the right-hand side just shows the Just Transition Finance tool, which the ILO launched at COP, and we were really delighted to work with them on that. So with that, Prasad, I'll hand back to you and stop sharing my screen.
Thank you so much, Nick, for, so to say, setting the stage. I'd like to come to you now, Suranjali. If you could highlight the key recommendations or takeaways that we got from this research of the last 1 year. Over to you, Suranjali.
And thank you, Nick, for setting the stage for the report. I think it's a good time to talk about just transition in India because it's embedded within the dialogue on sustainable finance. And I talk about, the developments that we've seen over the last 1 year, which in fact point to the acceleration of the concept of the principles of just transition within the transition plans that we're seeing for India. So I think the first important thing is to look at the launch of the low carbon development strategy, and we look at the language of the report, which talks about the just, smooth, sustainable and inclusive transition, which means that the priority of leaving no one behind is specifically mentioned therein. We've also noticed that there is a significant lack of or gap in private finance, which is through the measured requirement, which is $10 trillion. And we see that there will be gaps which need to be filled by the private sector. And that underscores the need to scale up finance that supports a just transition. We're also looking at a year when India is the president of the G20 and is talking about what needs to be the focus for sustainable finance in India. And within we see a focus and an underscoring of the orderly, just and affordable transition, which again speaks to the expansion of the agenda on sustainable finance, which includes a just transition in the focus. At the developments over the last 1 year. We've seen the maiden sovereign bond issuance, which in itself in the framework incorporates and acknowledges the social dimension, which includes co-benefits such as employment generation and support to the MSMEs. We've also seen the mandatory reporting by companies under the BRSR, which has come into play, which has a very clear social dimension included. You have employee stakeholders, human rights and environmental protection. As part of that, we're also seeing the expansion of the green bond framework or the strengthening of the green bond framework within India, which basically underscores again some of the principles of just transition. So the context for India has been set. even if you look at terms of the priorities. So over the last few years, we've seen that there's been a significant push towards skilling initiatives. There have been financial innovations around this. So the launch of the impact bond for skilling is an example of how just transition related activities there's a potential for scaling up finance there and are part of the priority. There's also a need for recognition that this transition will be spatially different. It will affect different regions differently. We've also already seen that with extreme weather events. And therefore, there's a need for a region-based strategy. And perhaps the thinking has already begun in specific states setting up the task force on just transition. Over the last few years, we've seen that there's been growth, but with informality, and there has been lack of adequate gender representation. And I think just transition offers an opportunity to relook at these issues. We're also seeing that in the COVID period and the period following that, there's been a specific stress on the growth of MSMEs with specific support in terms of credit. So I think there is also a push there to bring smaller businesses that are part of the value chain into the process of the transition, and therefore makes it just. There's also, as I said, in terms of skilling, so there is also creation of good jobs as a focus, which again is private sector engagement, and actually in about a minute, how there are already companies that are working towards this. And as I mentioned, there is significant gap. And in this report, we look at how to fill this gap through the private sector and DFI and MD. Just before I move on to the key recommendations of the report, this is to show that private sector is sort of moving ahead fast in terms of adopting some of the principles of just transition. So one of the key policy levers that have been used in the past is the mandatory CSR spend, which interestingly has been carried out by some of the large fossil fuel companies in India. Look at NTPC or Coal India, which have supported CSR activities in different regions where they are located. Although we see through the map in India's map that it is still in regions which are relatively industrialized, but there is potential to scale it up in regions that will be adversely impacted by the transition. And if you look at even World Benchmarking Alliance's assessment, there are fossil fuel dependent companies that are today already engaging with stakeholders in terms of reskilling employees or generating green jobs. And from this, from all these developments that I've sort of talked about, the report picks up from there and gives 10 key recommendations. I think the first is quite intuitive to say that there have to be some regulatory signals and incentives for private investors, to move towards a principle-based framework of just transition that needs to be operationalized through a definition. The second that we sort of recommend is that India should stimulate the corporate sector to set up a just transition task force, because the private sector has to lead this space by defining what is being done and assess the different risks and engage with the stakeholders. So we suggest that cohesive thinking on this within the private sector can be extremely strategic for driving the just transition agenda and sort of fitting that in within the net zero plans, actions, as well as disclosures. I had already mentioned the BRSR in some ways has the S element incorporated well. I've shown the map of CSR. It's possible to sort of scale up on activities which are linked to just transition, not just skilling, but going beyond that. So I think CSR is a very important lever which can also be used to scale up other sources of finance, which may be looking for capital that needs to take care of risks. Then we need investors, and bank and capital markets, to factor in just transition into their plans. This is because investors will drive capital allocation and through their business engagement can drive change within the private sector. I think one of the key changes that is required or the driving force for just transition will be innovation in financing. So we've seen in the past that there have been impact bonds such as the skill development impact bond that was issued in India, which is a very interesting cooperation between public and private finance and philanthropies that come together to scale up in activities such as skilling. And so we can imagine a spectrum of activities that are just transition linked, which can be financed through this route. So I think there is a great deal of, there's a need for innovation. As I mentioned earlier, that there is going to be a gap in finance from what is being estimated, and therefore there is need for international public finance and private finance. And India, interestingly, has its offshore center and GIFT in Gujarat, which is an important channel through which international finance can flow in, because there are different kinds of regulatory and tax incentives available. As mentioned earlier, MSMEs are already a part of India's planning process. There is prioritization of MSMEs, and I think they can be fit into the overall strategy for just transition. An important element, again, is the MDBs and DFIs. They have different levers by which they can drive change, that is through development policy finance. They can do that through their own internal frameworks, and we're already seeing some level of engagement within India towards this end. To change in the direction of a just transition, and this could be particularly important, again, in the space of green jobs and skill development. And linking back to innovative instruments and international public finance would be the use of blended finance. Mean that there could be credit guarantees provided by institutions that are willing to take on risks for activities that are more just transition aligned. And this is the G20 year, so it's important to stress that different countries can talk to each other, and India can drive change by talking about developing interests and find methods to scale up the different kinds of capital that we have identified in our report, and to enhance cooperation on scaling up of finance in just transition. That's all. Thank you.
Thank you. Thank you so much, Suranjali. And this is very useful again, these recommendations, I'm sure, to our panelists. You might like to look at these recommendations and give your reactions. So as I said, I'm going to begin with you, Kate, and request you to reflect, of course, on the recommendations, the report itself. But importantly, since ADB has been doing so much on just transition and that you have a lot of experience working in other countries as well, I would like you to talk about ADB's initiatives on just transition, and then obviously reflect on some of the recommendations which Suranjali just articulated. So over to you, Kate.
Thank you very much, Prasad, and thank you for the opportunity to speak today. And firstly, just to say congratulations on the launch of the report. I think for the introductory remarks, there's lots to say, but I have limited time. So I think I'd like to first reflect on two aspects of the report, I think, that resonate with the work that ADB is doing. And the first is, I think, a few key points about the way that the report and the work frames the issue of just transition. And then the second, as you mentioned, is on the role of the MDBs and the recommendations that feature there in the report. So I think firstly on the framing, one of the key messages that comes out of the report, which I think is really crucial, is the benefit perspective. You know, we know that net zero can't be an agenda that competes with agendas for economic development and poverty eradication. So, you know, we need to continue to move away from this idea of countries being faced with a trade-off between rapid decarbonisation and other development goals. And so building on that, we we can't view just transition as just a harm minimization approach, but rather see it as an opportunity. And I think that comes out in the report, around it's an opportunity to build human and social capital as we transition. And I think particularly for India, with such a large and growing population and many development challenges, that there is obviously big development challenges in diversifying away from fossil fuels, but it's also a country that has enormous capacity for innovation and rapid economic growth. So how can we actually harness that potential? The second, I think, is on practical actions, which you mentioned yourself, Prasad. The momentum around just transition has really grown exponentially, but it's still early days, particularly for Asia, in terms of practical ways that we will implement it. But we don't have a lot of time to wait. So I really think that this year needs to be a year where we move forward from kind of conceptual buy-in on just transition to practical actions and examples. And so I think the report is really valuable in that perspective, that it sets out some very clear and practical financial actions that can be taken. And maybe the third point I think that resonated is on tailored solutions. And the report highlights the need for sector-specific approaches and place-based approaches. I think particularly we see the dialogue around just transition outside Europe. It's now moving to where it's focusing on 4 or 5 key countries. And rightly, we often look to South Africa as the first JETP country, the first country where the climate investment funds accelerating coal transition IP was approved. And there's really valuable lessons there. But I do think that we need to support analysis and dialogue that looks specifically at different national contexts in different countries and the challenges and application of just transition there. The second thing I think was on the MDBs. So, in the report, there's some really clear ways that the MDBs can support the agenda. And ADB, but all the MDBs actually are really working hard on just transition. And I think there's a lot of work going on in terms of how we develop an operational framework and how we mobilize the entry points that we have as MDBs to support just transition. And, there's really clear alignment there to link back to that point on the benefit agenda. The core mandate of MDBs is development and poverty eradication. So as we push forward, and particularly ADB, as we push forward with our increased climate finance targets, then it's absolutely essential that that just transition part is there. I think in terms of how ADB is developing our operational approach, I think there's good alignment there between that and the recommendations in the report. I think maybe just to highlight 4 dimensions of how we're looking at working on just transition. So the first for ADB is an operational framework. So how does the concept of just transition link into existing policies, into our safeguards framework, into the work we do on poverty and social analysis, and how do we ensure that just transition is really embedded effectively and meaningfully into our operations. I think the second is how we ensure that the activities that we do to support climate action also work for just transition. So one of the examples from the report is ADB's energy transition mechanism, which is a financial market-based mechanism to support early retirement of coal-fired power stations. So that is a clear example of a climate project, a climate mechanism that ADB's come up with. So how do we ensure that just transition is really clearly part of that and a driver for how that's rolled out? The third, I think, is how we mobilize our expertise and operations. So so many of what we see on the solution side for just transition, education, reskilling, social protection, even things like trade facilitation, economic diversification. They're areas that MDBs work in, that they have resources for, that they have lending. So how do we mobilize expertise and operations in those areas to align with the climate agenda, with the transition agenda? And then I think the last one, which is also important, is how MDBs can take advantage of our long-term time horizon. Because there's obviously immediate needs, but when we're talking about transition and talking about moving whole sectors and moving economies, how can MDBs use that long-term time horizon and that long-term relationship that we have in countries to support those transitions over the longer time frame? So I will stop there. That was just some initial reflections that I had. And thank you very much again for having me on the panel.
Thank you so much, Kate. I really liked your 4 points of different ways of engagement, and you articulated them so very well. And I'm glad that many of our recommendations actually resonate with what you already have in your operational modalities and frameworks. One question to you, Kate, since many MDBs have now recognized the importance to support just transition, has there been any efforts on harmonization, a kind of an approach where there are, jointly developed frameworks coming up, especially to leverage more and more private sector finance coming in, and also aligning with the national government policies? So any discussions, dialogues going amongst the MDBs on JT?
Yes, quite a lot, actually. And this is frequently a question that we get from all sorts of stakeholders and from our donors on how we are aligning and working together. So we have a few different ways. We actually have a joint MDB Just Transition Working Group, which is really useful. And that's kind of an open space where we can share amongst the MDBs, because for a lot of these things, there isn't precedent, right, on how you establish an operational framework for just transition. So having that opportunity to share is really useful. And then we are also having a lot of different discussions on harmonization of approaches. So that ranges from some of the upstream analytical work. So for example, some of the approaches on socioeconomic impact analysis and what type of approaches we take, what type of assumptions we make, and trying to make them consistent. To other things, for example, on frameworks. So in India in particular, the World Bank is has been doing a lot of work on just transition frameworks for coal mine closure. And so we've been talking to them on using the same framework and aligning it to make sure that there is a consistent approach and to make sure that we're not duplicating efforts. So we hope to, I guess, make some more concrete steps on that. But yeah, the discussions are ongoing.
Thank you so much, Kate, for this. I'm going to move to you, Neha, now, because some of the recommendations you've seen already in the report talk a lot about mobilizing finance through instruments like bonds, and you have a lot of experience with the Climate Bonds Initiative. And as Suranjali highlighted, we got the first sovereign bond out in this year, 2023. So would really like you, Neha, to not only reflect on our report and the recommendations, but also talk a bit about where do you see the growth and of the bond market in the just transition space. Over to you, Neha.
Thank you, Prasad, and congratulations to everyone who's been working on this report. I think it's the 3rd of the series. Tremendous work done. When I was reading the report, I have been involved on this issue for a long time. And when I was reading the report, I actually picked out sections which were very enlightening, and I had something to say. So I will take the opportunity of this discussion to also point out some of those sections. So first of all, congratulations on this work, because I think the report lays out the guiding principles of next actions, which will of course get much more granular. But I see the report in all of its recommendations as setting out the guiding framework of how to, start thinking about some of these issues. One of the sections very clearly mentions three aspects, which you say that, which I consider as guiding principles, that just transition framework should be able to help you anticipate, assess, and address social risks to livelihoods. The second is identify and enable opportunities. And third is meaningful dialogues. And I think this is crucial to operationalizing any kind of just transition approach to mobilizing finance or capital allocation. So this was very interesting to see that it was very clearly laid out. The other topics, the other sections that were visually also very, descriptive and instructive were, of course, on these depiction of workers, communities, consumers, and suppliers, and the principles that should be looked at within each of these stakeholder groups. These are important because I would like to come back to this question when we talk about operationalizing just transition, especially for mobilization of finance for capital allocation through instruments like bonds. I would like to comment, and I have a couple of comments on some of the points that you mentioned as 7 key levers in terms of financial policy and regulation, the business effort for inclusion of just transition, and there are 2 points. Kate has already looked at MTB and DFI, so I will not touch upon that, but I would like to look at investor engagement, and especially in that context, capital markets role. There is, Suranjali mentioned, of course, that the role of CSR is going to be very important. Having worked on this issue for a very long time within the larger framework of business responsibility, and you also mentioned in the report that there are a couple of, what should I say, knotty issues which will need to be resolved. Suranjali, what I really found interesting, and I could probably elaborate a little bit or add to it, not elaborate that much, that CSR money is basically the basket which looks at corporate philanthropic. It is a philanthropic money which goes out of corporate entities. And one fundamental thing in our law, as far as CSR is concerned, is that it cannot be linked to any strategic gains of the parent company. And that is a very important part to be understood when you're trying to use CSR as an instrument. And I see that you can use it in 2 ways. One is that your stakeholder group of communities basically then becomes that one particular stakeholder group to which CSR money can be directed in the context of just transition in 2 ways, I think. One is you use it as a blending finance instrument. So you have philanthropic money. You basically start looking at how would you blend finance for just transition. And second, you should be able to, and you can definitely look at it as a direct support, right? Direct support for community development. But both of these things will need to be looked at in some sort of a distance from parent company. The moment anything translates into strategic gains for your parent company, that will lead you into legal hassles, which are very difficult to resolve because the law is completely, very, very strict about that, which means that not only your categories under Schedule 7 will get affected, but also larger legal framework within which the CSR is framed. And this is important in terms of also when you're looking at just transition, not in terms of transformational capital that you will require for community development or skills training in different sectors. You could look at you could look at agriculture, you could look at any sector, you can use this money because corporates are obviously active in all of the sectors. That's one thing. I'm sorry I've taken a little bit more time, but I really thought that it was an important one to point out. The second thing that I really like, congratulating also the authors, is thank you for saying that it is a multi-sector concept. We do tend to look at it very narrowly, only in terms of coal decommissioning and phase down, but dislocations in terms of jobs, job substitution, and job generation would be a multi-sectoral dimension of just transition. And clearly, one would then have to look at how do sectoral transition pathways include some of these dimensions. Right now, transition plans or transition pathways only look at environmental and climate aspects. How do you integrate social aspects? And going back to what Nick was saying then, it is really a matter of looking at environmental and social together rather as very separate filters, which are currently the way everybody looks at investments or financing just transition. Decarbonization and social outcomes are looked separately by lenders and investors and even by borrowers. How do we make that next level jump in integrating just transition will perhaps be part of, taxonomies, standards, embedding it in certain aspects, which I will come to later, but that I would like to cover in the operationalization aspect, especially for capital allocation through instruments like bonds. I mean, I can go into operationalization right now. There are certain things, but it's up to you, Prasad.
Yeah, in fact, this was going to be my question to ask. So you might as well, please take the operationalization part. Take a case of bonds as an example.
Actually, it is agnostic to the financial instrument. Operationalization simply would mean that you are addressing two aspects. You're addressing the risk management aspect, which is your first guiding principle, and you're addressing the opportunity aspect, which is your second guiding principle. And which also would mean that you will look at the process aspects of how you integrate, which means you would have a plan, you would have a mitigation strategy, you would have some indicators, and that's the process part of it, right? But when it comes to performance, then things start becoming interesting because that's what investors are looking at. And there, I would like to push the envelope a little bit from the concept of social co-benefits to actually substantial contribution, because that's the opportunity. That's the opportunity that you have to sell to financiers, to investors. That's what they're looking at. So while social co-benefits could be two jobs, right? But substantial contribution would actually mean that you have taken into account your social risks and social opportunities and have actually looked at what is the percentage increase, quantum leap in either job creation or in terms of access to goods and services, or in terms of even community empowerment. So operationalization, from my perspective, would be, to take the much more known term, which has been popularized by, say, EU taxonomy, take a substantial contribution approach and take a do no significant harm approach, and then start looking at whether your entry point is environmental, which is what we are looking at, it is just green transition. And then you say, for me, Prasad, it basically falls into three big buckets, okay? Suppliers you can add. You have workers, consumers, and communities. It looks at sustained job opportunity creation, which can be very, very, it can be broken down into indicators. You look at access to opportunities that can be broken down into qualitative and quantitative indicators. You have already mentioned World Bank benchmarking alliance. You have fast infra, all of those things. So I think this can be very clearly done in terms of metrics, which are both quantitative and qualitative. And that is very much a possibility. I would say in terms of now the bonds approach, you can take two approaches, either a green plus approach. You have green bond, and sovereign bond issuance is a great example of actually a Green Plus approach, where you can on-lend or direct that capital mobilized for place-based interventions at state level or in other sectors that you deem important, right, within your national framework. And then you can take another approach, which is a separate label. Both these approaches are gaining traction. There are various investor alliances which are looking at separate just transition label, or embedding or integrating the just transition elements through integrating social aspects in green bond frameworks. So I think that is very much something that we need to be working towards. The test would be whether we will be true to label or not. And being true to label would mean that you will have clear metrics, because that makes the job of any financier, any investor, any banker much more easy.
Thank you, Neha. I think you articulated the concept of integration so well. And the Green Plus says that. In fact, when you bring that term Green Plus, it just says it all. I think this is a good point for now coming to you, Williams, to reflect on the report. And you coming from the banking institutions, you might like to take the thread ahead, what Neha just talked about, and the value addition, which will happen as a part of the opportunity, not just limit to do no harm risk principle. Over to you, Williams.
Thank you very much, Prasad. Thank you, everyone. And hello, good morning, good afternoon, good evening to all the audience. Thank you so much for inviting me to join this wonderful panel, connecting with different key stakeholders in the ecosystem. I think it's great that we have this group and the collaboration. And actually, I've been learning a lot from all the other speakers and panelists. I smiled a few times when Neha was talking through her points, and actually a lot of what she said also resonates with me. And also congratulations to the team on the launch of the report. It is a wonderful report, very comprehensive, lots of practical ideas and recommendations for actions that resonate. I think it's the actions that we really need to take on next as an industry and as a market. So I represent HSBC Asset Management. I work in the responsible investment team under the stewardship and engagement team, and we invest on behalf of our clients with just over $600 billion of asset under management across different asset classes. And actually, India is a key market for us. In my day-to-day role, I focus on engaging with companies across our portfolios, including India and across asset classes. So actually, and we've been starting to speak to Indian companies as well as other companies in Asia Pacific on the topic of just transition. So actually, the focus, I guess I'll focusing on my reflections on the reports around the section on institutional investors, the section around scaling up investor action through business investments and capital allocation, as well as engagements with companies. I think for me, just echoing what Neha was saying earlier, I think when we speak to companies and to have more comforts around understanding how they look at just transition, and for us, it's like Nick and Neha said earlier, it is essentially overlaying a human impact and social lens over climate change, and that fundamental belief that the climate transition will not be able to happen, it will not succeed if it wasn't just or inclusive and equitable. And so we really need to think about how stakeholders are impacted, how different vulnerable groups are impacted. So as we engage with companies in our portfolios on their transition plans, and actually when you look at the level of uptake on climate transition and on the idea of net zero in the last few years, and the adoption of climate disclosures at the corporate level, through TCFD or through ESG reports, that's actually grown quite significantly, and lots of Asian companies, lots of Indian companies now have voluntarily through alignment with TCFD or now with the SEBI's BRSR requirements, are disclosing a lots of data and qualitative and quantitative data around their climate strategies, around their targets, around their GHG emissions, and so on and so forth. But actually, the impact of these strategies and these plans on different stakeholder groups is still very limited. And so this is certainly an area that it would be good to that we want to engage with companies on. One of the challenges we find when speaking with companies, not just in India, but actually across the spectrum, even in a lot of developed markets, is currently sort of the lack of awareness of what is just transition, or what frameworks can we use, or what standards can we use to report, and and you can see that through the WBA assessments, the World Benchmarking Alliance's assessments and indicators. The scoring of those 180 companies that they've done for a lot of companies globally is actually quite low. And it's no surprise either when you look at the Climate Action 100 benchmark. Again, the Just Transition indicator, no company at the moment has fully met the expectations. But actually, for us, if you think about if you really think about human impact and the social lens and sort of that labor risks, etc., of climate change, we do have a lot of frameworks already, and we do have a lot of standards already, whether it's the ILO, whether it's the UN Guiding Principles for Business and Human Rights, the UNGPs. And so a lot of that socialization and engagements with companies is actually trying to communicate and encourage them to adopt a lot of these existing standards and frameworks, but at the same time also engaging with standard setters and policymakers and regulators to actually let's, and I think somebody mentioned this earlier with the social taxonomy, and it's highlighted in the paper, having these more sort of industry agreed standards that enable and allow companies to report against. I think that's the key, an important point. And then maybe just one more challenge or observation that we have that we see with companies on just transition, and this goes back to Neha's point earlier around operationalizing how they report and what they report, and it's a lot of companies already reporting on a lot of social indicators, such as the, say, attrition rates of their workforce, the number of training hours for their workforce. So all this will feed into the data that can enable us to look at, well, what about the targets, the metrics, the KPIs, and the targets to make an informed decision around how well the company is doing in terms of thinking about the stakeholder impact. But importantly, it's not also just about the input indicators, not necessarily just how many hours of reskilling or upskilling or training that you have done with your workforce, but the outcome and the impact of that. So if seeing companies to report against, well, what does that mean in terms of the number of roles or jobs that have been redeployed as a result of the retraining or upskilling? Those will be a lot more meaningful as sort of indicators. And this is having these indicators, as Neha said earlier, will really help give more comfort and assurance to investors when they are assessing companies' performance and practices around their ESG, but also crucially, increasingly looking at the impact and the outcomes of their ESG and sustainability strategies. I will pause there. Thank you.
Thank you. Thank you so much, Williams. I think you really underscored the importance of having indicators and, leveraging on the existing reporting systems. And then in some sense, bring in more and more transparency in understanding efforts being taken by a corporate in just transition. Actually, I was thinking to move, into a discussion of Q&A, because there are some questions, Williams, I thought may be very relevant for you to chip in. And I also want to bring you, Nick and Suranjali, in answering these questions. We have very interesting questions here in Q&A box. And I'll pick some, and some of them are directed to specific panelists, which I would do. But to start with, Williams, there's a question coming in from Sangeet from DIW Berlin. The question is that, is there a differentiation in financing for the just part via grant money versus concessional lending for other net zero activities? So question is there a differentiation in financing when it comes to the just part via grant money versus concessional lending for other net zero activities?
That might be on the grant money side in concessional finance. So our investments and the investments that I support the fund managers to look at are typically in mutual funds and in vehicles that invest in public equities or public fixed income. So I may not be able to comment necessarily specifically on grant money or concessional finance from that perspective. But I think if you're looking at the just aspect, for me, I think it needs to be integrated into how you assess the overall, whether it's a project level or an asset, or indeed for us, the investment level will be at the companies, and forming that overall holistic picture of the company's strategy, for example. So I don't think it will be enough going forward to only look at one particular parts, whether it's the climate transition or how good the climate plan is, without also taking into account the social elements, the potential impact that the company or the project has on the different stakeholders. Because if you get that wrong, there will be a lot of sort of issues down the line and potential liabilities down the line that are not being taken into account in the investment today.
Maybe, Prasad, I could come in on the concessional financing if
Please, Kate. Yeah.
So I think the answer is that there's a role for both, right? The just transition needs are quite complex, and I think we need different types of financing for different parts of what's needed. For example, from an MDB perspective or ADB perspective, there's actually activities that we already do that can be used towards the just transition, and that doesn't necessarily need a different type of financing from what MDBs do regularly. So, if that's education lending or health lending, technical assistance work on social protection, things that we already do, but they need to be oriented towards where the demands are going to come as for just transition. So it's really, I think Nick said it, about linking, right? The agendas and the planning and the identification of those financing needs with the transition discussion and anticipating where those needs will be. But then there is definitely going to be a role for grant financing, because I think particularly around some of the larger climate projects, we can't necessarily layer them up with every single requirement that's needed for a comprehensive approach to just transition, because the projects themselves will not be viable, and therefore we will actually stop doing climate projects as well. So it's really a balance between how we take a comprehensive approach to just transition, but also still enable the climate activities to go forward. And so in that case, I think then that's when you need a role for grant financing to be added onto other projects or to fulfill a gap that perhaps can't be built into the financial structure of the project, then I think the other role of grant financing, or maybe when we need to think innovatively, is on the timing, right? A lot of the support that needs to happen for the just transition actually needs to happen ahead of when the climate project happens. So if you look at economic diversification or creation of jobs, that actually needs to come in well ahead of when the financing comes in for the climate activities. So in that way, it may not be part of that climate project because the timing is completely different. So then that's maybe, then that's when there's perhaps a role for a grant facility or a different type of financing facility that can do early interventions to support the just side and then bring in the other financing for the climate side behind it. Thanks.
Thank you. Thank you so much, Kate. I think you need therefore both. It's not either or case. You need to have both the grant and the concessional finance. Nick, I have a question here, very interesting, because you talked about it. Sujay is asking, is there any role of the loss and damage fund in just transition?
It's a great question, and I don't have a direct answer to it.
Thought so. It's a great question. Absolutely.
I think what is interesting is clearly just transition is largely being thought of in terms of achieving the sort of decarbonisation goals, net zero, and so on. What we're seeing is, and I think Suranjali, you highlighted it in your presentation as well, is that we can't now ignore the actual impacts that are already happening. The loss and damage is already happening, and the actions that we need to take to deal with that and provide funding for affected communities, and also to make communities resilient. So I think that perhaps is one of these things to be taking forward, and obviously we're the main focus is to make sure that the loss and damage fund is not a fund in name only, that there's real funding and so on. But I think questions of sort of social justice, social inclusion will have to be sort of key in terms of making it real on the ground. But a great question. I saw that and thought, that's a good question. I don't know the answer, but it needs to happen.
Yeah. Thanks, Nick. Another question, Suranjali, I would like you to comment. This is from Professor Uday Shankar. He's asking, again, a very interesting question. What do you see role of microfinance when we talk about financing just transition?
Thanks, Prasad. That's a really good question, because as I said in my presentation, the spectrum of instruments that we are looking at, as we mentioned specifically at the beginning, that there will be different kinds of communities and there will be different kinds of demands on finance. And I think microfinance is really the inception or the first sort of thinking behind impact bonds. I think impact bonds are a derivative of the thinking that went behind microfinance. And I think there again, there's possibility to link the S element with finance using microfinance. So I think there's scope there to scale that up as well for segments where the requirement for funding is small. And I think this also speaks to the pillar on consumers that we were talking about. So it's not just about jobs, it's also about consumers, and microfinance institutions sort of cater to that segment of the transition. So I think they have a key role to play.
Okay, thanks, Suranjali. I think I have another tough one, I think I must say. I think the question is coming from Elena, and this is addressed to both you, Kate, and Nick. And the question is, could you share examples of large carbon-intensive corporates introducing policies or actions that align with just transition and are best class on this? Is it too early to say, or I don't know? I leave it to you, Nick. You want to dig first, and then Kate.
I think we are having examples. Most of the ones we've seen and looked at are, I suppose, where you have seen action taking place and results in terms of impact, in terms of, I think, what Will was saying, in terms of results for workers and communities that have been in Europe, maybe because the transition is going on a little bit longer. So Potential companies I would cite here would be Enel, the Italian company, which has just transitioned very much as part of its process. EDF, its work in France. Obviously, EDF has some operations in India, so I think there's some interesting transfer opportunities or the ideas there. And then in my country, in the UK, SSE. But I would highlight that these are maybe because this has been going on a little bit longer, and also obviously the sort of the context, obviously very different from India. So perhaps that is an area, and it's good to see that there are domestic and international investors starting that engagement process. But I think lessons can be learned, or maybe some of the core principles, but the application is obviously going to have to be very, very different in the Indian context.
Thanks, Nick. Kate, any quick examples?
I don't actually know if I'm the best person to answer this question. Maybe Will can come in, but I would say that they're willing to discuss it as part of the engagement, right? Which I think is a positive step forward. So if, you know, when we're just, let me go back to the example of the energy transition mechanism that ADB is doing, and we're looking at both public and privately owned power stations for early retirement and potential opportunities for that as part of the energy transition. And I think that private sector is very willing to engage on the just component of that entire dialogue, and, you know, recognizes that that will be a key part of engaging in that process. So I think there's definitely awareness there, and I think there's definitely a good understanding on what it means, well, growing understanding on what it means from our perspective. But maybe Will or Neha might have more examples specifically on corporates.
Yeah, so I would like to come in here citing a couple of examples which are not separately labeled as just transition, but these are large corporates in India which have been integrating social aspects and how they deliver services. I would give you some examples. For example, ITC, for example, which is a large conglomerate. The kind of work that it does with the communities in terms of how even the sustainability practices can be integrated, and then uses that community force to also direct its financing, which through various innovative mechanisms. It is not only grant, it is actually user charges, which are community led, kind of things. So the entry point is social, and then environment is on top of that, which makes it very integrated. So in India, I would say that because in that sense, just transition sort of precedes the climate conversation in terms of how companies have been integrating social aspects. You would find plenty of examples within the Tata Group, within some of the larger groups which have been trying to integrate and work on each of those things, whether it is the access to services, whether it is the sustained livelihood options and creation of opportunities, and very sort of prominently so in many cases on community empowerment. So I would say that it's not a separate just transition label. It is very much integrated into how they have been doing a lot of these this work. On the financial sector side, again, S gets included because it's part of our mandates also in financial inclusion. But I think corporate side is slightly ahead of, how things can be done, or there are more examples in the corporate sector than in the financial institution sector. I would venture to say so. Yeah.
Thanks, Neha. I'm just conscious about the time at the moment. We do have a couple of questions which we'll pass on to the panelists later. And thank you, Safa. Safa has just shared one of our reports on the how does one do step-by-step integration of gender into green bonds. This is something which, Neha, I'm sure you'll be interested. So thank you, Safa, for sharing. And now I would like to come to you, Manav. for your closing remarks. And I must say thank you all the panelists before that. Wonderful to have you here today, and we learned a lot from you reflecting on our report. And thank you for this opportunity. Over to you, Manav, for your closing remarks.
Thank you. Thank you to the panelists and speakers for your valued insights, and in particular to the report authors, Professors Nick Robbins, Dr. Prasad Modak, and Professor Suranjali Tandon. As mentioned by the speakers, the principles of equity and climate justice are central to India's approach to financing net zero and resilience by 2070. And this is also laid out in India's long-term low-carbon development strategy. As stated in the report, India has a potential to be the green jobs powerhouse of the 21st century, something the current government is particularly focused on. And 2023 has opened with a series of sustainable finance policy announcements, including in the recent budget that we saw, which signal the government's intention to mobilize private investment in ways that deliver both green goals and job creation. In other words, achieving net zero through a just transition. This signals a recognition that governed well, the transition will deliver significant economic and social gains. However, were it to be governed poorly, it bears risk of stranded workers and stranded communities. In addition to negative effects on people, this would also risk slowing the pace of change required to net zero and for resilient economies. The Just Transition Agenda represents a natural fit for British international investment. We have a core commitment to job creation and deep expertise in improving working conditions and running training and skills programs. Our expertise will be further deepened through the skills and leadership and job quality strategies moving forward. Sustainable and inclusive development are key objectives of BI's 5-year strategy, which speaks directly to just transition. Drawing from the report, MDBs and DFIs will be at the heart of helping to design and deliver any international public finance, especially as conveners of private capital at scale and as first movers building credibility around new financial structures, and industry taxonomies. BI is already doing this through our policies, processes, and investments. To start with, our policy on responsible investing, which includes a particular focus on job quality and safeguarding, including gender-based violence and harassment requirements in all our investments. These ESG requirements signal to private investors and the business communities that climate action should first do no harm in the social dimension, and that it should also contribute to improved social standards for workers and the communities. Our climate and ESG teams work closely together within the investment processes to identify the rising issues. As outlined in the report, in this coordination and cooperation between the climate and safeguard units is critical. BI is also financing long-term regional and sector development, going beyond the conventional boundaries of finance by investing to address climate and social impacts. In these sectors, we are supporting the development of wider green economy via investments such as organic milk-based Akshay Kalpa, which work very closely with farmer and dairy communities. As the report also says, there is an increasing importance for cooperation on just transition. BI is using its position as thought leader to raise the just transition agenda amongst the DFI groups, such as EDFI. Looking ahead, BI has the investment tools and approach mentioned in the report that can enable mobilizing of private capital towards just transition. Via our VC strategy, we can give entrepreneurs access to capital and capacity building initiatives, which is crucial to achieving an economy-wide just transition. In sectors such as agriculture, for example, our investment in VC fund Omnivore, which has an agriculture and climate strategy within the overall generalist strategy. For example, via blended finance solutions that can attract private investments through technical assistance and concessional financing. This is something which different panelists spoke about recently. This is supported, for example, by our TF facility, BII Plus, and the 200 million climate innovation facility, which was announced by the UK government at COP26. BII will continue to launch, evaluate, learn from pilot just transition projects, and to engage with thought leadership on just transition. We are strategizing the next steps of the initiative, starting with scoping new just transition opportunities within our team in India. We will also continue to design green skilling programs and interventions. We are also developing an in-house view of success and learnings of our pilot projects to inform the wider strategy going forward. We have recently concluded our next year strategy, which puts inclusion and impact at the heart and center of everything that we do. BI is committed to being part of addressing this challenge and to ensure the benefits of transitioning to net zero and resilient economies must be shared by all. And with this, I once again thank you all the panelists and audience. Thank you very much.
Thank you.
Thank you, Manav. And I think this is the time to say goodbye, and we continue our interactions anyways. It was wonderful to have all of you here today. Please do send your comments on email to BII. I don't know maybe who will be the contact point, but maybe you can let us know, Amal, and people could then send their comments. So good evening, good afternoon, and we close for the session now, and let's stay in touch. Thank you very much.
Thank you so much. Thank you.
Thank you very much.
Congratulations.
Thank you. Thank you, everyone.
Thank you. Bye.
Thanks.
Thank you.
Sharing, Prasad. Thanks.
Thanks.